If you're 65 or older and you filed your taxes the exact same way you did last year, there's a very good chance you just handed the IRS money that Congress already said you don't owe. Not because you did anything wrong, because nobody told you the rules changed. And quick heads up, this is general information based on current federal rules, not personal tax advice, because everybody's return is a little different. Now let's get into why this matters, because what I'm about to walk you through could be worth thousands of dollars this year alone. Here's the situation. Every year the tax code and the Medicare rules shift a little. A threshold moves, a new deduction gets created, an old form gets updated. Most of these changes don't make the evening news. They show up as a line in a 40-page IRS bulletin, or a number buried on a government website, and unless you or your accountant happens to be reading that specific page, you never hear about it, so you keep filing the way you always have. You keep paying the Medicare premium you've always paid, and the money that was supposed to be yours quietly stays with the government instead. This is not a loophole. I want to be really clear about that word because loophole makes it sound sketchy, like you're getting away with something. You're not. These are provisions that Congress and the Social Security Administration wrote into law specifically for people your age. The government already decided you qualify. The only thing standing between you and the money is whether you know the rule exists and whether you take the one step required to claim it. So where does this information actually come from? Not opinions, not rumors, actual federal sources. The senior deduction I'm going to show you first comes directly from Section 70103 of the One Big Beautiful Bill Act, which is now written into the tax code under Internal Revenue Code Section 151. The Medicare premium fix comes from Social Security Administration Form SSA 44, which exists specifically to handle what the SSA calls a life-changing event. The prescription drug relief comes from the Inflation Reduction Act's expansion of the Extra Help program. Every number I give you today ties back to an actual federal rule, not a guess. And because these numbers get adjusted or expire on a schedule, I'll flag exactly which ones are locked in and which ones you should double-check closer to filing season. Let's start with the newest one, because most retirees have genuinely never heard of it. Number 1, the new $6,000 senior bonus deduction. This is brand new. It didn't exist before 2025. Under the One Big Beautiful Bill Act, if you're 65 or older, you can now claim an additional $6,000 deduction directly off your taxable income. If you're married and both spouses are 65 or older, that's $12,000 combined. Here's what makes this one different from other senior tax breaks you may have heard about. It doesn't replace anything you already had. It stacks on top of your regular standard deduction, and it stacks on top of the extra standard deduction you already get simply for being over 65. So picture a single filer, age 68, taking the standard deduction. In 2026, that standard deduction is roughly $16,100. Add the existing extra amount for being over 65, a little over $2,000. Now add this new $6,000 bonus deduction on top of both of those. You're looking at close to $24,000 of income that never gets taxed at all before you've done a single bit of planning. For a couple where both spouses are 65 or older, that combined shelter can approach $50,000 when you stack all three pieces together. Now here's where it gets important. This deduction phases out as your income rises. For a single filer, it starts shrinking once your modified adjusted gross income crosses $75,000, and it disappears completely at $175,000. For a married couple filing jointly, the phase-out starts at $150,000, and the deduction is gone by $250,000. Most people stop here, but don't, because here's the part they never tell you. This deduction is only guaranteed through the 2028 tax year. It was written into law as temporary. Unless Congress extends it, this window closes. If you've been putting off a Roth conversion or timing a large withdrawal, this is a limited time opportunity to do it while an extra $6,000 or $12,000 of income is shielded from tax. What most retirees do wrong here is nothing. They let their tax software apply the old standard deduction amounts from muscle memory and never realize a brand new box needs to be checked. On the 2026 return, this deduction gets claimed on a new form called Schedule 1A, which flows into your 1040. If your tax preparer or your software is not asking your age and applying this automatically, ask directly whether Schedule 1A was used. Let me put a real example in front of you because the number only means something once you see it applied. Say you're a single retiree, 67 years old, with about $52,000 in total income between Social Security, a small pension, and IRA withdrawals. Before this deduction existed, your standard deduction package was around $18,150. Add this new $6,000 bonus, and you're now shielding roughly $24,150 of income from federal tax, which for someone in the 12% bracket works out to an extra several $100s staying in your pocket instead of going to the IRS, just for existing at your current age and income level. Now flip it to a married couple, both 68, combined income around $95,000. They're well under the $150,000 phase-out threshold, so they get the full $12,000 combined. Layered with their existing deductions, that can shelter close to $50,000 of their income entirely. Same law, same form, and most couples in that exact income range have no idea the number even changed this year. Number 2. Fixing an inflated Medicare premium with Form SSA 44. This is the one that can be worth the most money, fastest, for people who recently retired. Here's the mechanic you need to understand. Medicare doesn't set your monthly Part B premium based on what you're earning right now. It looks backward 2 full years. Your 2026 Medicare premium is based on the income you reported on your 2024 tax return. For most retirees, that's not a huge deal, because income tends to be fairly stable. But if you retired in the last 2 years or your income dropped sharply for any reason, you are very likely being charged a premium based on a paycheck you no longer receive. In 2026, the standard Part B premium is $202.90 a month. But if your income 2 years ago put you above certain thresholds, you don't just pay that standard amount. You pay an additional surcharge on top of it called IRMAA, the Income-Related Monthly Adjustment Amount. For 2026, that threshold sits at $109,000 for a single filer and $218,000 for a married couple filing jointly, based on your 2024 income. Cross that line, and your monthly Part B premium can jump well past $280. Cross into the higher brackets, and it can climb past $680 a month per person. For a married couple where both spouses are on Medicare, that's a difference that can run into the thousands of dollars per year, and it applies to your Part D prescription premium too. Here's the part almost nobody knows. There is a federal form built specifically to fix this exact problem. It's called SSA 44, and its full name is Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. If you've had what the Social Security Administration defines as a life-changing event, retirement, a reduction in work hours, the death of a spouse, divorce, loss of pension income, or loss of income-producing property, you can file SSA 44 and ask the Social Security Administration to recalculate your premium using your current, lower income, instead of waiting for the 2-year lag to catch up on its own. Now here's where it gets important. This is not automatic. Nobody at Social Security is going to call you and say your premium should be lower. You have to file the form yourself, attach documentation of the life-changing event, a retirement letter from your former employer works well, and submit it either online, by mail, or in person at your local Social Security office. For a couple who both retired from solid middle-income careers in the last 2 years and are still being charged based on their old working income, correcting this with SSA 44 can lower combined Medicare premiums by hundreds of dollars a month. Most people stop here, but don't, because this form isn't a one-time thing. If your income drops again in a future year for a qualifying reason, you can file it again. Here's what that looks like with real numbers attached. Imagine a couple, both age 66, who each earned $95,000 in their final year of full-time work. That 2024 tax return put them at a combined income that pushed them into an IRMAA bracket, so in 2026, both of them are being billed the surcharge rate on their Part B and Part D premiums, even though they've now been fully retired for over a year, and their actual current income is roughly half of what it was. Multiply that surcharge, times 2 people, times 12 months, and you're easily looking at a difference of $2,000 to $3,000 a year compared to what they'd pay if Social Security were looking at their real current income instead of a paycheck that no longer exists. File SSA-44 with a copy of the retirement letter from their employer, and the Social Security Administration recalculates their premium using an estimate of their current year income instead. That correction typically shows up within a couple of billing cycles. What most retirees do wrong is they assume the premium notice they got in the mail is final and non-negotiable. It isn't. It's a starting point based on old information, and the form to correct it takes about 15 minutes to fill out. Number 3. Extra help for prescription drug costs, and the new hard cap on what you'll ever pay. If you're on a Medicare Part D prescription drug plan and your income is limited, there is a federal subsidy that can reduce your drug costs to almost nothing, and the eligibility rules are more generous than most people assume. It's called extra help, sometimes referred to as the Part D Low Income Subsidy. For 2026, if your income is roughly under $23,940 a year as an individual, or somewhere around $32,000 for a married couple, you very likely qualify for the full subsidy. Once approved, extra help pays most or all of your Part D premium, eliminates your deductible, and caps what you pay per prescription at a small flat amount, a few dollars for a generic drug, and roughly $12 to $13 for a brand name drug. Here's the part that surprises people who assume they make too much. This program used to have 2 tiers, a full subsidy and a smaller partial subsidy, which meant a lot of people got turned away or only got partial help. That 2-tier system is gone. If you qualify at all under the current income and asset limits, you get the full benefit, no partial version anymore. Now here's where it gets important for everyone on Medicare, whether you qualify for extra help or not. As of 2026, Medicare Part D has a hard annual cap on out-of-pocket prescription costs of roughly $2,100. Once your spending on covered medications hits that number in a calendar year, your cost for every covered prescription drops to zero for the rest of the year. This is a genuinely new protection. For decades, there was no ceiling at all, and seniors managing a serious illness could face tens of thousands of dollars a year in drug costs, with no limit in sight. That era is over, but the cap only helps you if you know it exists and you're tracking your spending toward it. Most people stop here, but don't, because there's a second layer almost nobody checks. Even if your income is a little too high for extra help, most pharmaceutical manufacturers run their own separate patient assistance programs for people struggling to afford a specific brand name drug. These are worth a 5-minute search for the exact medications you take. Picture a widow, 72 years old, living on a Social Security check and a small survivor pension that puts her right around $22,000 a year in total income. She's been paying a Part D premium every single month for years, plus a copay every time she picks up a prescription, without ever applying for extra help, because nobody at her pharmacy or her doctor's office ever mentioned the program existed. Once approved, her Part D premium drops to close to zero, her deductible disappears, and her copays fall to just a few dollars per prescription instead of the full retail cost. Over a year, for someone taking 3 or 4 regular medications, that's routinely a savings of several $1,000s. What most retirees do wrong is assume a program with the word low income in its description doesn't apply to them because it sounds like it's meant for someone in more extreme financial hardship. It isn't. The 150% of poverty line threshold is more generous than people assume, and a lot of retirees living comfortably but modestly on Social Security alone fall well within it without realizing it. Number 4. The Social Security taxation trap that's been frozen since 1983, and the tools that get you around it. Here's a fact that catches almost every retiree off guard the first time they hear it. The income thresholds that decide whether your Social Security benefits get taxed were set by Congress back in 1983 as part of the Social Security amendments of that year. A single filer starts owing tax on part of their benefits once combined income crosses $25,000. For a married couple, that threshold is $32,000. Once combined income crosses a second, higher threshold, $34,000 single, $44,000 married, up to 85% of your benefit becomes taxable. Here's what most people don't understand. Those numbers have never been adjusted for inflation, not once in over 40 years. If they had kept pace with inflation since 1983, those thresholds today would likely be 2 to 3 times higher than they actually are. Instead, because wages, pensions, and investment income have all grown over 4 decades, while these thresholds stood still, more retirees cross that line every single year, often without realizing it until they see the tax bill. You can't personally change a threshold set by Congress, but you have real control over your provisional income, which is the number that actually determines whether you cross that line. Retirees who are strategic about the timing of IRA withdrawals, who use Roth conversions in lower income years before required withdrawals kick in, and who use qualified charitable distributions directly from an IRA once they're 70 and a half, can often keep their combined income below these thresholds and avoid a meaningful chunk of tax on benefits that other retirees end up paying every single year. Most people stop here, but don't, because this connects directly back to item number 1. That new $6,000 senior deduction lowers your taxable income, which can indirectly help keep you under these Social Security taxation thresholds too. These provisions aren't separate silos. They interact, and a good tax season is one where you look at all of them together rather than one at a time. Here's a simple example of how this plays out. Take a married couple with $40,000 a year in combined Social Security benefits, plus $20,000 a year pulled from a traditional IRA. Add half their Social Security to their other income for the provisional income calculation, and they land just above the $44,000 upper threshold, meaning up to 85% of their benefits become taxable income on top of everything else. Now imagine that same couple, in a year when they don't need the full $20,000 from the IRA, pulls only $10,000 instead, and covers the gap from savings that don't count as taxable income. That single decision can drop them back under the threshold and meaningfully shrink how much of their Social Security gets taxed that year. What most retirees do wrong is treat their IRA withdrawal amount as fixed and automatic, pulling the same number every year out of habit, without ever checking whether a slightly different number would keep more of their Social Security benefit untaxed. Number 5. Medicare Savings Programs. Help with your premium that most retirees have never even heard mentioned. This is different from extra help, and it's aimed at your Part B premium rather than your prescriptions. If your income is limited, your state may run what's called a Medicare Savings Program, sometimes shortened to MSP. Depending on which specific program you qualify for, an MSP can pay your monthly Part B premium for you, and in some cases, it can also cover deductibles and coinsurance. Here's the part that trips people up. These programs are run at the state level through your state Medicaid office, not through Medicare directly, and not through the Social Security Administration, which is exactly why so few retirees ever hear about them. Nobody at Medicare is required to mention a state program to you. The income limits vary by state and by which specific tier of the program you're applying for, but many retirees living primarily on Social Security, especially those already receiving extra help for prescriptions, are automatically enrolled or qualify without realizing it. Here's the part they never tell you. Even if you were turned down for an MSP a few years ago, income limits get updated, and it's worth checking again, because a lot of retirees who didn't qualify 5 years ago do qualify now. The action step here is a phone call to your state Medicaid office, not a Medicare number, asking specifically about Medicare savings programs and Part B premium buy-in. Number 6. The senior property tax break that most people file for once, and then forget, exists. Nearly every state offers some form of property tax relief once a homeowner reaches a certain age, usually somewhere between 62 and 65. The specific mechanism differs by state. It might be an additional homestead exemption, a freeze on your assessed value at the year you turned 65, or in some states a full exemption from local school taxes. Here's what most people don't understand. In the majority of states, this is not automatic just because you turn the qualifying age. You have to file an application with your county assessor's office, usually a short one-page form. Once it's on file, the exemption typically continues for as long as you own and live in the home, though a handful of states require you to renew it periodically. The dollar value ranges widely. In a modest tax county, it might save you a few $100s a year. In a high tax county, it can be worth $2,000 to $3,000 a year, every year, for the rest of the time you own that home. Most people stop here, but don't. Because here's the part almost nobody asks about. Several states will let you apply retroactively and recover exemption years you missed if you never filed the form. It costs nothing to ask your county assessor's office directly whether back year relief is available in your case. Number 7. Filing status and the extra standard deduction you may be forgetting to layer in. This is the oldest, most basic senior tax break, and ironically, it's the one people forget because it's been around so long it doesn't feel new or exciting. Simply by being 65 or older, you're entitled to an additional amount added on top of the regular standard deduction, separate from the new $6,000 bonus deduction we covered earlier. For 2026, that additional amount is a little over $2,000 for a single filer and roughly $1,600 per qualifying spouse for a married couple. Here's what most people don't understand. This applies whether you take the standard deduction or whether you itemize is irrelevant to some of these provisions. But this particular add-on specifically boosts your standard deduction. So if you've been itemizing out of habit from your working years, it's worth running the numbers both ways this season. Because for a lot of retirees whose mortgage is paid off and whose itemizable expenses have shrunk, the standard deduction plus every senior add-on now clearly wins. So here's what I want you to actually do with all of this. Pick the one item on this list that applies to your exact situation right now. Maybe you retired in the last 2 years and your Medicare premium never adjusted. Maybe you've never checked whether you qualify for extra help. Maybe you didn't know the $6,000 deduction existed at all. This week, go to ssa.gov and search for Form SSA-44 if the Medicare premium issue applies to you, or go to ssa.gov and search Extra Help if the prescription drug relief applies to you. Both of those applications take well under 30 minutes, and both are handled directly through the Social Security Administration, not a private company, not an insurance agent trying to sell you something. If this saved you even one thing you didn't know before, that's exactly what this channel exists to do. Plain explanations of the tax and Medicare rules that actually apply to you at this stage of life, without the jargon. Subscribe if you want the next one, because next week I'm walking through the required minimum distribution rules that changed again for 2026, including a deadline a lot of retirees are going to miss without realizing it.